Do you guys know what an emergent property is? I'm talking about a property that like emerges. So emergent property is when you mix two things together and you get the benefits of both those two things, but then you also get a third thing. And that third thing comes into play and you start getting that benefit because you mix the first two things. Makes sense? Yeah. It's like if you're smoking, you feel one certain way, right? And if you're drinking, you feel another certain way. But if you smoke and drink at the same time, you feel a third type of way. You feel twisted, which is like a combination, but something better maybe. I've just seen that on TV. Or here's a better example, when two people love each other. Or actually, they don't even need to love each other. Maybe they're just smoking and drinking together. And then when they mix, in the morning, you get the emergent property of a baby brewing in the oven. It's beautiful. It's how all life works. Aristotle actually used all these examples when he said, the whole is greater than the sum of its parts. The whole is greater because of the emergent property. You guys get it. So how does this relate to markets? Well, in markets, people love to debate which is better, fundamentals or technicals. They are two hardcore camps that love to go at each other. The fundy guys say that the tech guys are basically just like 3-year-olds painting some ugly ass pictures all over their charts. It doesn't make any sense. The tech guys say that the fundy guys are pretty much just jerking themselves off over 10Ks and pictures of Warren Buffett. Neither believes in the other side's method of analyzing the markets, which is sad because in reality, both of them are great. And together, if you combine them, they will be even greater. They belong together, like peanut butter and jelly, or like socialism and Democrats trying to buy votes. It's just meant to be, because when you combine fundamental analysis with technical analysis, you get that emergent property. Both of them feed off of each other, they inform each other, and at the end of the day, they add to your bottom line. So let me give you an example. One of the things you're trying to do when you're investing and you're an individual investor is invest with the big money, because the big money is what's going to push stock prices higher. So your goal is to try and invest in something before that big money spots it and then pushes it higher. Because if you get it at a really good price, if it's undervalued and then it shoots higher, you're going to make money, right? That's pretty basic. We understand that. So where does the big money come from? Well, a lot of it comes from institutions, right? Because they're managing billions and billions of dollars in the market. And the way institutions invest, like pension funds, is based off fundamentals mostly, because they got those huge gobs of money, right? They're not going to be trying to trade off of technicals, getting in and out of positions real quick. You can't do that. They're way too big. Plus, these guys got to sound smart and they got to wear ties and they got to be all stuffy because otherwise they're not going to raise money. And there is no way you are going to sound smart talking about technicals and whatever little magic lines you drew. Got to stick with the fundamental analysis like Warren Buffett. And this is a better analysis path for them because, like I said, they're not jumping in and out. They're investing for the long term. So they do their fundamental analysis, make sure that the company is good, and then they put a bunch of their money into it and sit. So if you want to invest in those same companies before they get in, so again, they could push the stock price higher with you in it, then you got to do the fundamental analysis, right? See what they're looking for. But the problem is that sometimes you do the fundamental analysis and you figure out a great company, really undervalued, and you jump in, but then nothing happens. The stock just keeps going sideways for months and months and even years. But you know it's a great stock because you did the analysis. So what's the problem? Well, the problem is that the market might not have realized it yet. The institutions might not be on it yet. So what you got is dead money. And no one likes dead money. No one likes dead things in general. Unless you're into necrophilia, which, you know, I'm not judging. Because recently I learned that gender is just a social construct anyway. So I'm sure whether something is dead or alive probably falls under that same category. So I figure to each his own, right? But to avoid this dead money problem, you use technical analysis. This is where it comes in. Because technical analysis is what helps you with the actual timing of when to make the investment. So you could use breakouts, indicators, whatever type of technical analysis you want. But the point is it's telling you when to get into that stock. Because what it's showing you is when the market realizes that what you found is a great investment. So they start investing. It's funny because there are so many investors that are trying to find secret special gems in the market, right? That no one else has found before, which is all great. But for the price to move up, other people have to find it. You want other people to find it once you're in so they can push the price higher. That's the whole point. You need buying pressure. So technicals tell you when that buying pressure is coming in so you know when to actually invest. That way you're not sitting with dead money and you're only in the stock when it's moving higher. So you can see how taking those technicals and overlaying them over the fundamentals is really important. And at the same time, technical analysis needs fundamental analysis too, because you can be out there with all your indicators catching breakouts left and right, but so many of them will fail, a much higher percentage than if you have fundamental reasoning backing it. Because if there's nothing backing a move, then it might just be a short-term jitter and the breakout will fail and then you'll lose money. You just increase your probability of hitting a winner when you have some fundamental reasoning. Check out this example of Cloud Peak Energy, something we were playing in the Macro Ops portfolio a few years ago. ago. And MacroOps, if you don't know, is the global macro research and consulting firm that I co-founded. So one of the plays that Alex looks for in that portfolio is beaten down stocks. So Cloud Peak Energy was in the coal industry, which was really beaten down. You can see here that by the time we were looking at it, it was down over 95% since its highs. Searching the sector and this specific stock, and remember Alex is our lead guy who manages a portfolio at MacroOps, he saw that the market beat this stock down way too much. Like 95% is a lot. And through his fundamental analysis, he saw that the picture was actually changing for this company. Things were looking a lot better, but the market was still underpricing it. So he figured this out in February of 2016. So imagine if he got in right here in February because it was a great fundamental play. Well, then he would be sitting there with pretty much dead money until July. Because look at this thing, it was just basing. But instead what Alex did is once he found this fundamental thing, he sat on it. He just waited. He didn't put his money in. Because what's the problem with dead money? If you have your money in a stock that's not moving, then that capital is tied up and you can't put that money elsewhere where it can actually make you more money. So in this case, you would have had that dead money for 6 months. So that's why he waited. He waited until he saw this technical break right here in July, the end of July. You see it's a nice full body candle with solid volume, and you see that it came off of earnings. There's an earnings report right here. So even in this one instance, you see that price has reacted from a fundamental factor, which is the latest earnings. And this is where that emergent property becomes the most prevalent. This is what we call an inflection point, because it's telling you off this earnings, the institutions and the markets have realized this is a good stock and they all piled in. So that's telling you that it's finally time to invest, which is what Alex did. And because he waited for that emergent property, from that breakout, he made almost 200%. And that was in a very short period of time, as you can see here. Great return. So you can see the benefit of combining the fundies with the technicals. And maybe you might have noticed, but this Cloud Peak Energy turned into a penny stock. It wasn't when we were investing in it, but you can see what happened when we caught this move, this 200% move. That was it. That was the high for the stock. And since then, it's been just trending lower and lower, and now it's a penny stock. So maybe our analysis was wrong. Long term, this play didn't work out, but thanks to using technicals, we were able to catch it and make 200% on it. And you know, I always talk about why trade management is so important. This is a great example right here, because this thing didn't work out long term, but we still made 200%. And technical analysis really comes into play when you're trying to manage your risk, because we were able to sell out with large gains before the thing turned around and retraced everything. Technicals are so key for risk management and just trade management in general. And that's one of the things we go over in the price action masterclass, which I know I've told you about this all week, but it is closing today. So you're not going to get a chance to enroll after today. Well, not for the foreseeable future, because we have so many products launching this summer that we're not going to have this thing open for a while. And as I mentioned before, you're getting 40% off if you enroll. And in this price action masterclass, we go over all this stuff about trade management, how price action should be used, how it can be combined with fundamentals, and you just get really deep into what price action actually is. And everything I was talking about in this video about emergent properties, how to combine the two, that's the type of stuff you're going to see in this course. It's not just focused on stupid Fibonacci lines or something like that. You're learning the true first principles of price action. So remember, that shuts down today, so definitely go enroll in that if you're interested in doing technical analysis. And there's no risk to check it out because there's a 60-day money-back guarantee. So if you watched it, realized you knew everything that was in the course, or it just wasn't for you, there's no problem. Like, you just email us and we'll give you your money back. But I'm pretty sure you're gonna like it. So go check that out. There's a link up above and down below in the description and comments on the page where you can go and you can learn all what's in it. There's even a sample lecture in there. It is good stuff. 6.5 hours of good stuff. It's long, but it's long because there's a lot of stuff we had to get through. So go check that out. Closes today. And if you haven't already, make sure you subscribe to this channel and smash that notification bell so you get email notifications of our future videos. We got a bunch of stuff. I'm doing a lot more videos again. I kind of slowed down on the videos a little bit because I was working on another course for you guys, which will be released in a few weeks. Like I said, lots of products coming out this summer for you, but we're doing more videos on the channel again, so subscribe so you can see those. And in the meantime, stay fallible out there. I'll talk to you in the next video. Bye.